You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
One of the things people are asking me right now is just how long can these market rallies continue? We're 2 years out of date for a change. How much longer can go on?
Jim, until we get a setup to cap it, it's all about the structure. And I know, you can't give a hard answer and name, the top tick and the time and the moment, but it's about the setup. And when I say the setup, it's the structural setup with the cycle, and then and then I don't know how to explain that. It's market structure. Right translated cycle, left translated cycle, what degree of the cycle, and then the underlying technical picture that occurs in conjunction with that setup that matters to give you the DNA marker, if you will, to cap it. And until that happens, it can continue higher. And it's going to continue higher. Back in 2000, once the setup occurred, boom, done. In 2007, once the setup occurred, boom, done. This time, we have seen a setup that'll kind of try, it can't stick, and it morphs away. Nothing concrete has set up like we saw back in 2000 or 2007. And so until that happens, the bear market rally continues.
Is it because of all the quantitative easing programs that have happened in Asia, Europe, and the U.S.?
In part, yes, of course. And it is because that people have been trained. They know that there's going to be stimulus, that there has been stimulus, that there's been the powers that be have had the markets back, kind of like the Greenspan put, remember that? And people have been trained, so that optimism is in the market, and it's like turning a battleship. It's going to, until that optimism turns, and until the powers that be lose the effectiveness, the setup cannot occur, will not occur, because everything's discounted in price. And when I talk about the structure, I'm talking about the price bars and how they appear structurally within the context of the cycles on the chart. And the human emotion, the buying and selling of equities, it appears in the form of a price bar. At the end of the day, you have an open, high, low, and close, and the structure surrounding that is what matters. So, again, as long as optimism is high and there's no fear, and the Fed has everybody's back, and they continue to talk about this, the quantitative easing, it can obviously go on much longer than one could ever imagine. But that said, as stretched as it is, I never thought we would get to this point. How much longer it can go on, I don't know.
And of course, that's the question so many people are asking because they want to time getting out of the market at just the right time. Is that a mistake for a lot of people? Should you take a look? Gee, I've made 30% on my stock portfolio right now. Maybe I should bail and just take my money now? Or if people expect the markets to continue to rise, do you continue to ride it?
From my perspective, you continue to ride it until you get, if you're still in, I would be afraid to get in at this point because, the train has left the station, a long time ago, and, it's getting close to its destination. So do you get on the train this late in the game? My answer to that would be no, but if I were on the train, then obviously I would want to wait till it got to its destination to bail. And so that goes back to that setup until, you see these setups try to take place. And for example, let me back up. I may have mentioned this in the last interview, I don't remember, but until 2014, we saw nothing. And when I say nothing, the market never attempted to even set up for a top. But since 2014, we'd see one or two of the little parts fall in place, and it'd try, and then it'd morph away, and market go higher. And we'd see it try it again, and it'd morph away, and market go higher. And so we're seeing it try, but again, it hasn't solidified, if you will. And so the answer to when to jump ship is when it solidifies. And you know, you can't know in advance when that is, but you know it when it occurs, when you see it, if that makes sense. And, you know, when I talk about these markers, Jim, I've taken them back. That's the reason I developed these things, is because, you know, how do you know if a cycle has truly topped or not? How do you know if it's really extending or if you're just seeing a correction along the way? And if you don't have signposts, if you don't have something solid that you can look at and go, yeah, this is a real danger sign, or everything is okay, then you're guessing. And for example, back in 2011, at that top, people were panicking. We were, you know, 2 years out from the 2009 low, and that was fresh in everybody's mind. And I remember at that top, that was as I remember, roughly 18% decline, I think. That got people's attention. And I remember getting phone calls that going, is this a 4-year top? Is this? And I said, no, we're going higher. And I remember that was a May high that occurred. I said, no, we're going higher. We're going back above the May high. And the reason I said that, as bearish as I was, or still am long term, I said that because there were no markers. There were no markers. And going back to 1896, I've identified a specific set of common denominators that have occurred at every 4-year cycle top. Every 4-year cycle top. And so until you see that, you know, if it's happened at every one of them since 1896 and it hasn't happened here, then, hey, you can only assume that you haven't had the top. But then at the same time, you know, that cuts both ways. Once you see those things fall into place, or you see them trying to fall into place, then it's a warning at the point that you see them trying to fall in place. But then once it happens, and like I said, it solidifies, if it's happened every time since 1896 and it happens again, I would say that's a pretty strong indication that at that point you have something.
We'll have more with Tim Cyclesman Wood right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Tim Cyclesman Wood. Tim, I know that we're not going to look at it specifically, but I think when people see large climbing numbers, they get fascinated. In Asia, people are signing up new stockbrokers like crazy, 1.5 million new stock accounts a week in China as their markets hit new record highs. But our people, again, it's almost like there's a big fire over there. Let's go take a look. Maybe we'll throw a log on that fire and see what happens. But the odds of getting burned are pretty good.
Well, you know, I don't study the Asian markets. Just looking at the chart, though, I pulled up a chart of the Shanghai, and it's just straight up. It's parabolic. I mean, it truly is. I mean, the thing has gone up. Let me just look at this. Since February, it was roughly at 3,000 on the Shanghai. Now I'm looking at, I guess this is the close as of yesterday, it's over 4,000, so 1,000 points. I mean, that's 25% advance. Or, no, it's a 30% advance. In just, you know, a month and a half, 2 months. And so, you know, that's about as parabolic gets. It did the same thing going into the 2007 top. I'm looking at the chart. And, you know, I don't like parabolic advances because it also, if you look at the rise into the 2007 top, you know, and it's just a historical fact that, you know, you tend to take out or return to the point to where the parabolic move began. The question then becomes, though, how high and how far and how long is the parabolic rise going to take that market before it peaks? And my answer to that again is it's the same. It's about the structure. And when you look at the structure of the market concerning, you know, surrounding the 2000 top in the Shanghai then, it had the same sort of structural setup to cap it. that was seen in the industrial. So the same rules apply. I don't know how long it's going to go up. I think it's a parabolic advance. I think all of these stock averages are moving up into final highs before this bear market rally, and I'd like to go back and talk about that a little bit too, just absolutely implodes.
Where are we on the cycles for gold, crude, and commodities?
Commodities we have in general, and that includes gold and oil. You know, we have intermediate degree lows, cycle lows. Short term in gold, we had a sell signal, I don't remember, 3 or 4 days ago, moving into a short term a low. But we have the higher degree, and the same with crude oil. There was a little short-term decline the last several days, but longer or intermediate term. We have intermediate degree bottoms. Intermediate degree cycles are advancing, and those are counter trend moves. In other words, I think that we're set up for what should be multi-month rallies. And then I think the downward trend, the longer term trend, will continue down once those counter trend moves have run their course. And again, the answer to that is, you know, how long is this counter trend rally going to last? Is it going to be a month? Is it going to be 6 months? Is it going to top next week? The answer to that is it's about the structure again. When we see that shift from right to left translation, we see the DNA markers fall in place and so on and so forth, then you know that intermediate term bounce has run its course. Right now, there is an issue, for example, with just looking at, I don't remember the level, but looking at, don't have the chart, but looking at crude oil, you know, it needs to better, I think it was the February high, I think the number was 54.02 or something like that, but anyway, there's the previous February high. We have this intermediate term low, which is a positive thing, but then crude oil can't better that last high. So structurally, that's a little bit of a warning. So, you know, do we fail here? Do we get to set up here because we can't better that high? Or can it get above the high? And if it does, then it's got clear sailing and for the intermediate term advance to rip. And so we're at a bit of a juncture with crude oil, but I tend to think at this point that the bounce is probably still intact, the intermediate term advance.
Tim, why would you say we're in a bear market rally?
Jim, I think that I know that's a hard concept to grasp, especially with price at a new high. I totally get that. But it's about the underlying, I guess you would say, you know, technical conditions in which the rally has occurred. It's how do I explain this? I guess one way to explain it is that if you look at the volume characteristics of the market, that's number one. I'm looking at a long-term chart of the S&P in front of me, and anyone can go pull up this chart, look at it, and what you see is as the market rallied in the early 80s and into even the 87 top, volume expanded. And even with the decline into the 87 low, volume contracted. And then as we came out of that low and into the high into the 90s and even into the 98 4-year cycle top, volume again expanded. It contracted on the declines. And that is characteristic of a secular bull market. I mean, that's textbook. That comes right out of Edwards and McGee technical analysis book. Basic as basic gets. And within the context of that rising volume on the advances and declining volume on the declines, we also had the economy that peaked in or around 2000. If you look at the velocity of money, how fast the dollar turns over, that chart has been, you know, the velocity of M2 has floated around on the internet for years now. But, you know, it peaked in 97. And so you had a divergence, a non-confirmation, if you will, with the velocity of money and the equity market with the economic top in 2000. If you look at the job participation, the labor force data, it peaked in 2000 and has just, totally collapsed almost. In my opinion, it's back to levels from the mid to late 70s. And so those are clear indications that the economy peaked in 2000. And then when you combine that, or overlay it, if you will, with the fact, with the volume characteristics, that the secular bull market also peaked in 2000. And then if people will just stop and think and look at the actions by the money masters since the 2000 top, sure, there's always been, interest rate hikes and cuts according to the market, but that's been market driven. And, but you never saw the level of outright manipulation to try to keep the market afloat that you've seen since the 2000 top, and it's been increasing in insanity, the levels of that they have gone to try to keep this thing going. It started out with interest rate cuts, which led to QE1, which led to QE2, which led to, and it just, and then every central bank across the planet has done their part to try to stimulate. And so you have to ask yourself the common sense question, why? If things are so good, why are they doing this? Well, it's because things aren't good. It's because it is a bear market rally. It's because the velocity of money has contracted, and they're trying to stimulate it, just like the chart says. It's because the job participation rate has collapsed, and they're trying to stimulate it, just like the chart says. It's because the rallies in the stock market are on declining volume now, and the advances are on increasing volume now, which is a mirror image of what we had going into the 2000 top, which is this mirror image, that is, let me be very specific, with the declining overall volume on the advances and the advancing volume on the declines, which we have seen since the 2000 top. That is characteristic of the secular bear market. And so those are the reasons that they're doing what they're doing. And it's not because they're good guys and they just want to save your 401k. It's because they see the condition of the global economy. And the implications, I guess, of this thing when it comes unwound, and that's what they're trying to prevent with these actions. And so to look at this and say, well, we're at a new high and it's a secular bull market, is not exactly as it appears, I promise you. And so it is for those reasons that I'm convinced it's not. It's just not a secular bull market. It's not. It is a rally that has been extended and pushed and beyond belief within the context of a secular bear market. And when the wrapper comes off this thing, I'm telling you, I think it's going to be global in nature. I think it's going to be far worse than the decline into the 2009 low, and I don't think there'll be anything they can do at that point because they've shot their ammunition, so to speak. And once the control is lost, once the public confidence is lost, and it's exposed for what it is, I think it's going to be one hell of a horrific outcome. But in the interim, it just keeps going and going and going. And it's going to continue until, like I said earlier, we get that set up. When we get that set up, it's going to, the risk goes off the chart at that point. And, anyway, I need to do an article maybe, and I've done it before. Maybe I need to do an article showing some of this stuff. But it's because, people get lost in price. They look at that and go, well, he's crazy. There's no way it's a bull market. It can be a bear market where price is a new high. Oh, yes, it can. And it is. And in fact, there's a historical precedence even, back in, the rally in the 70s between the 66 and 74 bear market. the market's moved in one of those 4-year cycle advances to a slightly new high. And so it absolutely can happen. And when you combine it with the stimulus that we've seen and people being trained because of that stimulus and the optimism that it has spun, it absolutely can propel it to a new high. But it hasn't changed the underlying facts.
Thanks a lot for chatting with us, Tim.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Check out our YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.